Welcome to Momentum Mode. My name is Corey Farringle, and you'll hear me alongside my co-host Mike Shannon shortly. This episode will feature an interview with Ira Weiss, a founding partner of Hyde Park Venture Partners. Not only is Ira a longtime venture capitalist, but he's also served on the boards of many companies and is the venture capital professor at University of Chicago's Booth School of Business. We'll cover a wide range of topics such as how a board evaluates a CEO, what investors look for in companies and leadership teams, and also how board members communicate with one another. But before we jump in, we'd like to thank our sponsor, Kilpatrick, Townsend & Stockton, an innovation-focused law firm with 22 offices around the world, including our hometown of Chicago. Also, thanks to Mike's company Improve and Corey's company Aperion Ventures for their support of the pod. Now to the episode. And today we are joined by Ira Weiss. Ira, so if you're in the Chicago area and you're an early stage tech company, you know Ira, because one of the things Ira is best known for is as a founding partner of Hyde Park Venture Partners. Not to be confused with Hyde Park Angels, which is a different group that Ira also ran in the past. And additionally, Ira is a professor at Booth, and venture capital is one of the key topics that you bring up. So you do there. So you're raising our future leaders as well. And Ira, I lost count. How many boards do you serve on now?
Right now, I'm on 9 boards.
9, okay.
Board and board observers. That's actually down a couple from what I've been on historically. But...
Yeah, it's when you go through your LinkedIn, it's like how many boards and advisory boards, but that's really the life of an investor, right? And a professional board member, effectively, which is the world you live in. So,
and I never take them down from LinkedIn because what's the point? So.
Right, exactly. Well, and even when you say you're not there anymore, they keep them on there. And historically, you're like, oh, okay. It's funny. People have told me you don't need a resume anymore because you have LinkedIn. I'm like, just go look at people's LinkedIn. It's pretty confusing. So our goal today is to understand from your perspective as an investor, as a professional board member, what does it mean, for companies and, opening the C-suites about helping those that are either in the C-suite looking for advice or aspiring, opening it up, what's going on in there, what's happening. So let's kind of start out that, as a board member, what's the hardest part about being a board member?
I think the hardest part for me about being a board member is just always trying to take that step back and think like, what are the 3 or 4 most important things to think about for this company?
Yep.
Because in a board meeting, you don't want to be the board member who's like talking all the time, and you want to kind of pick and choose things pretty carefully.
Yeah.
Because if you're talking too much, then people stop listening to you. So it's like, what are those 3 or 4 important things? And then also tracking the actual, we do a lot of venture-backed companies, a lot of startups, tracking their performance over time to make sure, okay, is this really going to plan? And plans in our world always tend to be optimistic. So even if it's not exactly going to plan, is it still going solidly enough that the burn, we think a lot about burn rates and how much money a company is using, is that tracking along with whatever the company's growth.
And so when it's those 3 things, are these things that, there's already KPIs, key performance indicators for? Are these things that you're like, maybe they're not thinking about? Like, how do you get to those?
It's a good question. Sometimes there are KPIs about them, but sometimes there aren't direct KPIs, and you're just kind of, there's a company I'm involved in where, you're realizing over time you thought that they had the go-to-market down, and for many, many years they had the go-to-market down, and they were focusing on a certain segment of certain customer segment, and then, that changed a bit over time, and you're like, oh, this has changed. What do we need to change? What does this company need to change in order to effectively be going after this new group and this new segment, which is a little different? So that's an example where, okay, that's one of the most important things now. Really, the whole organization's focus shifted because it is now really targeting. It's the same product, but it's targeting something slightly different.
And do you think, do you see those as like subtle shifts? Like management maybe didn't notice that yet? Or do you think those are overt and they all got it and they're bringing you, the board, along with them?
Well,
that was my question.
Yeah.
Did the CEO bring it to you, or did you bring it to them?
So sometimes the CEO and the team is really cognizant of it, and they're aware, it's a very thoughtful strategic shift.
Yep.
And other times, the company I'm thinking about in particular, it's a gradual change over time. That's common. A lot of our companies, they may start going after small and medium, the SMB market, the small and medium-sized business market.
Yep.
And then at some point, the offering is good enough that they can go after larger and larger enterprise customers.
Yep.
And, as a founder growing the business, you're doing your thing. and you may not realize, oh, we're starting to go after these larger customers. Like, are the sales motion that we have, what needs to change?
Yeah.
And you're like, well, now we're going after these bigger customers, but a bunch of stuff really needs to be different.
Yeah.
And that's not exactly how we were built.
Yeah. And so, like, how do you approach that? You just sit in a meeting and go, or do you go to the executive team later, just the CEO, when you start to see those changes?
Well, I think those kinds of things. Again, you'd asked before, well, is it you that notice it as a board member, or is it the management team? And sometimes it's the management team.
Right.
But those kinds of shifts that's why sometimes it is good to have a board itself and board members in the room, because they're seeing it kind of a periodic picture and a close picture, but a periodic picture. And when they see that periodic picture, they're like, oh, this is interesting. We now are really going after a different customer, but the organization hasn't fully adapted to that yet.
Right.
So I think those are that kind of taking the step back.
Yep.
And being able to look at that whole picture is one thing that boards can certainly be helpful with.
Now, how do you think you are typically coming in as an investor on the board? And so you typically have investor seats on a board and independent seats on the board. How do you think those play different roles on a board? Or do you see them as playing different roles?
I mean, I think I guess the way I think about being on board sometimes is I play a different role on different boards myself.
Okay.
And, there are certainly certain things that you want, like legally and otherwise, from the independents, but every board is a little bit different in terms of your involvement and also in board members' involvement. So like one of the boards, I'm like, I don't tend to, I'll talk here and there and I add my piece, but, it's given what other, the pieces that are on the board. My background is accounting. I was an auditor for a little while. I teach accounting. Some of the boards that I'm on, like I play a lot of the financial role, not for the company itself, but just I'm always the one that's harping on the burn rate. I'm always the one that's thinking about the metrics. I'm thinking about things like, financial planning analysis and kind of like planning ahead.
You're the fun guy on the board.
Exactly. Exactly. That's I'm the fun guy. And then other boards, like there may be people who've actually functioned as the CFO for a various organizations, and they're in many ways much better suited than I may be.
They might go deeper than you would.
They would go deeper, and also, may know like, okay, these things even that I'm asking about, not so relevant, not so important, but they know because they've been there and done that. The independent, it's interesting for some of our better companies. We have not brought on an independent very quickly. Okay. Where sometimes
what is very quickly? Like what stage is the company at when you might think that's needed?
Well, legally you may set up an independent board seat.
Okay.
So there's like, we typically get involved at the seed stage or the Series A stage. Often at that stage, there is no independent board member. Right. We don't require an independent board member. Mm-hmm. Sometimes it's just me and a couple founders on the board. Sometimes the next investor get involved. There may not be an independent. In our world, by the time you get to a Series B stage company, typically you'll definitely want, we definitely want someone who's independent on the board. Although at that stage, sometimes if the company itself is doing really well, adding another board member when things are already going really well, you're like, well, do we really need, how important is having this other voice in the room?
So real quick for those that aren't, what is seed versus Series A versus Series B?
So I think of seed and sometimes pre-seed. That typical company for us could be a company that, has a little bit of a product, or it has a product that has some early product market fit. In some cases, it may be nothing where it's a pre-launch company. Okay. But typically, when we think of pre-seed or seed, companies that have raised less than 2 or 3 million, probably at their really earliest stages of launching, very early stages of product market fit. By the time you get to Series A, for most companies, maybe a company could raise 5 to 8 million, maybe it could raise 8 to 10 million. For many companies, you already have some meaningful metrics, and you often may think that you have product market fit.
Right.
And
for my founder friends and myself, what is meaningful metrics in your perspective?
Meaningful metrics could be, $500,000 to $1 million in revenue. You have maybe a few people other than the founder doing during sales.
Yeah.
So like that's, in my world, in our world, we think a little bit about what are the milestones that you achieve at various stages. And so one thing to get to a Series A, if it's a company that does enterprise sales, can somebody sell this darn thing that's not just the founder? Because a lot of times the founders are doing all the selling.
You didn't live that at all.
Well, let me ask a question on this.
Yeah.
Every 2 weeks, I sit down with a dozen or so of my founder forum friends, right? One of the active gripes happening right now in the founder community is that those milestone bars have gone seemingly up of what is meaningful traction to get to a pre-seed.
Mm-hmm.
And I don't know what the trajectory has been over. I mean, I was raising capital 11 years ago, but why has that been, in your perspective? Why are the bars seemingly going up, or is that just myth?
I think we have been in a situation for the last couple of years, frankly, where the bars have been going up.
Okay.
And that is really it's just the capital markets. Like if you went back 2.5, 3 years ago, the private capital markets there was just so much capital in the markets.
Yeah.
You had all these crossover funds. You had a lot of very quick financings going on.
Yeah.
And it was good and bad. I mean, I think it lowered the cost of capital. It was easier for founders to raise money. That in some ways it's really good. But then the downside is there's not as much time for founders and investors to kind of date a little while to make sure they get to know each other, so you can kind of line up like, okay, this is the right relationship that I'm going to have. And, I think about it as, I wasn't a founder, but even as a founder, talking to my students a lot about this, if you end up bringing on an investor, it could be a 7 to 10 year relationship.
You'd rather have had the dating period. We've talked about this in one-on-ones. Yeah,
exactly. You would rather have had the dating period, got to know them get to know you, because you're going to be with them for a long time. And so you're getting, the basic question here was, well, why has the bar gone up? Yeah. The bar's gone up because there just is not as much capital right now flowing at the Series B through Series D. And those stages are, think about, we'll call them the growth stages, right? Someone's proven out mostly product market fit. If someone's putting capital into the business, they know it's a business that's losing money. But that by putting money in, there's growth.
And that's more of a Series B. You're probably losing money. Product market fit, meaning you know who our customers are. We know what the problems are. We know who the buyer is. And it's really just about putting money behind the go-to-market, the sale motion.
Exactly. That's a good way to describe it. And I would say that is the way that a Series B investor might think about it. But there still are things that could change at those Series B and later stages.
Like you typically catch the attention of bigger companies in the sector, and they may change their strategy to come deal with
or
you.
Maybe that's when you move from small and medium-sized businesses to larger enterprises.
The whole
or
sales motion.
You realize your sales motion originally was, you have some people on a phone, business development representatives on a phone calling people up. And then you get to the point, well, actually, most of the sales are through partnerships. You develop some really good partnerships. So there can be a lot of those changes over time. Getting back to the funding question, which I think is always very important for founders. Like, what is it going to take for me to get that next funding round done? I wish I could say there's like a far and fast rule. It is so dependent on the founding team, the experience level of the founding team, the sector that they're in, the stage of the business, because you could have someone who is a serial founder and they go to raise money and they could raise a Series A even though they haven't launched their product yet.
And what would make it a Series A? How much they raise at that point?
Yeah, how much they raise. Like they may not even have, whether you call it a pre-seed or a seed, it might be an $8 to $10 million round. And you're like, well, these people haven't even launched the product yet. But you know what? They had already launched a product in that sector before. They have a CTO that they've worked with before. This is a founding team that is experienced. They're going to be able to get going very, very quickly. And you know what? We as an investor, we want to be involved now. Because if we wait to get involved until some later point in time, it's going to be too late.
And so then you're backing people and their idea, but people goes to the top of the list at that scenario.
At that scenario.
So let me ask this question then. So every VC, you have your boxes to check on risk factors. Mm-hmm. You just noted that a serial founder may raise that capital with less traction than the new founder. So what tangibly are the boxes checked when you look at a serial founder versus a new founder? And I'm viewing that from the lens of, what does the new founder have to do to then check those boxes?
Are you asking for a friend?
No, I'm not raising capital. I'm curious though, because we don't see what your checkbox lists are, right? The proverbial list.
I mean, I think about it. So I think about it as maybe a checkbox list, but it's like list, but not everything needs to be checked off.
Yep.
Okay.
It is always the case. There may be 10 things that I want in any investment that I make.
Yeah.
And, on that list, that may be, a serial founding team that has worked together.
Yeah.
I don't get that box checked off very often. There's a
Right.
lot of really good first-time founders out there. But if that box is checked off, I know that I'm probably going to be able to spend less money. The company's going to be able to spend less money to get the same amount done in a shorter period of time. And so I am taking on less risk. The founding team has already spent probably someone else's money, maybe my money, but our money, but has learned a lot and had pivoted around. I teach a case in my class about a company called FeedBurner, which is a company that was based here in Chicago.
Yep.
And there's a serial founding team. Literally, they founded 3 companies. By the time they got to FeedBurner, that was their third or fourth, you could argue, but every company, they learned things from those companies. Yeah. And then they learned, an example is one of the early companies, they hired a VP of sales right away, a sales leader, but they didn't really have product market fit yet for the product. Yeah. But they knew the sector they were in, and they realized they were building the product. They kind of had a little bit of a product going, but the product wasn't at the point where this person could be that useful.
Right.
So they had to put this person, but this person actually they thought was going to be amazing. So they had to continue to pay that person for 6 months and not sell anything.
Yeah.
And then 6 months later, they could pick up and they can have that person sell again. So what did that team learn? Then the next company came along. They're like, they hired an HR person very early, a people person.
Right.
And that was all. And so the first mistake they made was the VP of sales. The second company they got to, like, okay, well, we need to spend some time on finding people, but we really, we don't like that. We don't like that aspect of our job as much. And so they hired a head of like an early HR person. That person, that was a very bad decision by them, because at the really early stages, what do you really want? You as the founding team need to be spending a fair amount of your time recruiting the right people onto your team. And if you're outsourcing that, it's a mistake. So by the time they got to the third company, ironically enough, given that I'm an accountant, they're like, we're just going to hire like a VP of finance admin person to do all this like stuff that we don't want to spend
all the
our
back
time
office
on.
things we don't want to deal with.
Exactly.
Yeah.
And lots of other stuff. So we could spend our time doing the hiring and finding the people. So this gets to your check box list. If I have a serial founding team, that's an example of what one team has learned over time.
Right.
There are a bunch of different things that the team has learned.
Right. Well, and for you to so for me as a founder to hear that, it's bringing it to a more tangible bottom line metric. It's not just your favoritism to this person who started more companies than me. You're actually looking at it and saying, well, if this is my first time, I may spend hundreds of thousands of dollars, if not millions, more than the more efficient seasoned operator, which maybe is just something out there for founders of pair up with the seasoned founders and see what they would spend money on or not. That would get them, the Ira Weiss check.
So as we're running lower on time here, I want to explore one other area. Is that as a board member, where do you spend your time? I mean, every board meetings and quarterly board meetings, is that it? Do you have other time with the company?
So what I like to do as the investor side is like whenever I make an investment in a company, there could be board meetings at some point, but I'll set up a regular touch base call with the founder.
And that's because they're earlier stage.
That's because they're earlier stage.
Yep.
So an example, one of the companies I'm involved in, it's called Audit Site, automates financial audits. I have a regular standing call every couple of weeks with the 2 main founders for that business on Thursday morning at 8:30.
Okay.
And so that was today. And that meeting is recurring. And that company itself, actually, we don't have board meetings yet.
Okay.
It's going on 3+ years. And that would be considered kind of like a board meeting, but it's every other week. For all of the companies I get involved in, I want to do a regular touch base call.
Outside of the board meeting.
Outside the board meeting. That could be once a week.
Yep.
It could be once every other week. It could be once a month. It can be pretty short.
Okay.
For this company in particular, I do 30-minute calls because we do them every other week. And there's a lot there's a lot going on with the company, and a lot that not that I know I can be helpful, but I try to be helpful with. So for this company, by having the call every other week, I actually ended up helping them source some customers.
Okay.
They are selling to accounting firms. The accounting firm that we use for our fund is Plant Moran. We had our accounting firm meet with them, talk to them. Eventually our accounting firm actually started adopting it.
Okay.
There are 4 other customers that they currently have that I have sourced for them through my network. That is not, I wouldn't say that's the norm.
Right.
For me, since I'm an accountant,
A little personal
as a former auditing,
affinity.
I've got more of an affinity and also just more of a network in that space.
Sure. Okay.
But that is something that, I want the time that I spend with them to be useful for the company.
Yep.
I don't want it to be time that people are just reporting to me. So I want to know, like, what is on your mind as a founder?
Yep.
Tell me what's on your mind. What is keeping you up at night, if anything's keeping you up at night? What are the big things that are coming down the pike 3 to 6 months from now that I could be helpful with?
Yep.
Or not helpful with. So that's how that's the regular touch base. And that, many companies, it may just be that.
Yep.
And then periodically there's a lot more if we're like hiring someone, if we're recruiting someone for the C-suite. Let's say I'm involved in recruiting a new CFO, or I'm involved in recruiting a head of sales.
Yep.
Then I might be much more engaged, or involved in the fundraising process is what I tend to get a little bit more involved in.
And you said you're doing this standing call, but you don't have a board meeting yet. Once you put a formal board in place, do you think you'd cut down on those calls, or is it now just a routine for both of you? This isn't sending to the company to tell them what the future is.
Yeah, I generally like to have those calls for as long as I can with a company, as long as I'm being useful. Maybe they'll cut them down to 10-minute calls.
Yep.
It's a 10-minute call once every other week where I touch base with the founder.
Yep.
At some point, there's a couple of boards I'm on where there's 4 or 5 different VC firms that have board seats.
Right.
We certainly don't want this to be a burden to the founder.
Right.
There may be a point in time, which has happened for at least one of the boards I'm on, where my use as an early stage investor, given the experiences I have, is frankly not that useful. And so maybe I reduce that to once a month.
You take the back seat. Some of the other board members step forward.
Exactly. Or eventually we cancel,
eventually
we're like, well, I'm not, if I'm not being useful after, 3 months of having this periodic call, I'm like, let's,
what am I doing here?
Let's have a call maybe just before the board meeting, and let's just have that one call. But we don't need to have, I don't want to waste the founder's time.
Well, and I found myself that if regular contact as a board member, regular contact with the exec team means I just have so much more context, and half my call isn't catching me up.
Yes.
And so then I just find it easier to have true contribution as an executive that only worked for me when I didn't have to prepare for all of them. When I could get on and we could just have a conversation. If I had to prep slides for you and I had to pull all the numbers, then I hated them, right? But if it was, hey, we're going to get on and maybe I look something up while we're on the phone, but it's a casual conversation, then it wasn't a big issue, right? So you always got to think about from both sides of it, right? How does it work?
And these kinds of calls for me, it's like they're literally 10 or 15-minute calls. Yeah. So there's no prep work on the part of the founder. And once there's a bunch of VCs, other VCs involved, 5 15-minute calls.
Right.
Every other week for a founder, that actually could be a lot of time.
That's
with
right.
people who are not really adding much value.
Right.
It's also the founder gets on the phone. You have a conversation with them. Then there's stuff that can be going around in their brain because of that conversation. So, I think you have to be.
And I'm a fan of the call. I had a weekly call, but the founder's likely prepping, even if the expectation is
absolutely.
So you really need to manage that.
Minimizing the amount of prep.
Yeah.
So
it's a no prep, but I prep 2 hours.
That is true. Where I'm like, oh yeah, we're not going to prep, but you're always feeling like, look, I need to be prepped. I need to know
they're going to ask this.
The 3 important things.
You're prepping for the call. Yeah.
So, well, Ira, that was terrific. We're running out of time here, so I greatly appreciate it, and I know we'll talk to you on other episodes because there's a lot of mystery in boards.
Wonderful. Well, thank you for having me.
Thank you.